Hey, quick question. If a stock costs $500 but is earning $600 per share, is it expensive? Hell no, it's not expensive. It's a screaming buy. Because price alone tells you nothing, but earnings tells you almost everything. And I'm showing you 3 stocks that prove that, so let's go. What's up? I'm Russ. I am a welder, so I have this very quick disclaimer for you. This is not financial advice. I am not an expert. These are not buy and sell recommendations. You always need to do your own research. So now let's get to it. Peter Lynch said it best, quote, "Behind every stock is a company. Find out what it's doing." And he also said the smaller the company, the more room it has to grow, and that's what we're focusing on today. Now, I ran a screen on SimplySafeDividends.com looking for dividend-paying companies where the current price-to-earnings ratio is below their 5-year average. That's my starting point to find potential opportunities where the stock price might be higher than it was, say, 5 years ago, but the valuation could be cheaper. And the screen returned 56 companies. So today I'm breaking down 3 that caught my attention after digging into the actual businesses, all with under a $100 billion market cap, all with growing dividends, and all with strong fundamentals. And if you want to run your own screen like this, SimplySafeDividends.com offers a 2-week free trial. And all you need to give them is your email address. I have a link in the description below. All right. Stock number 1 is Badger Meter, ticker BMI. And Badger Meter sells water meters to cities and utilities, both the hardware and the smart meter upgrades that use the magic word AI to detect leaks and track usage in real time. It's recurring revenue in essential infrastructure. Badger Meter, I love the name, has been doing this since 1905. They have a 21% return on capital. Water utilities have high switching costs, so once Badger's in, they stay in. But municipal budgets move slowly, and recent stock performance has lagged the S&P 500, and there is some investor caution around Q3 earnings as of this recording, but ultimately, water infrastructure isn't optional, which makes Badger Meter a long-term compounder. And here we are in the land of SimplySafeDividends.com, where Badger Meter, ticker BMI, gets a dividend safety score of 94, very safe. According to SimplySafe, they are undervalued, and they have a current dividend yield of 0.89%. But if you have a lot of investing years ahead of you, and before you need to use the dividend income to pay bills and live off of, a low starting yield but a high dividend growth rate should not scare you off if it's a quality freaking company. Check that out. A 10-year CAGR of 12.7%, almost a 14% 5-year CAGR, and they raised that dividend 18% in August of 2025, on top of a 32-year dividend growth streak. BMI is currently paying $1.60 per share per year. According to SimplySafe Dividends, using the 5-year average price-to-earnings ratio, we'll explain this first, is that SimplySafe Dividends takes the 5-year look back price to earnings ratio on average and gives a 10% area above and below that number, which is the gray shaded area. And they think when the stock is above that gray shaded area, you want to wait because it could be overvalued, but it should regress to the mean, go back to normal eventually. And when it's below, you probably want to think about buying. So right now it's below, and eventually it should come back up. So that is how they get their overvalued, reasonably valued, and undervalued valuations. One thing I love to look at as a very quick and dirty test if something may be undervalued on 2 fronts is if the dividend yield is above the 5-year average, which we see here it is, where the 5-year average is 0.74%. We're currently at 0.89. And then, voila, if the price to earnings ratio, this is the forward PE, is below the 5-year average, which it is indeed below the 5-year average. And before we move on, they are in the information technology sector. You know I love a low free cash flow payout ratio, and Badger Meter has historically over the last 10 years at least, except for 2015, had a low free cash flow payout ratio. Why do I love that? Well, because the dividend is paid out of free cash flow. Wherewith that free cash flow, you can pay the dividend, you can buy back stock, you can carry it as cash on the balance sheet, you can invest back into the business, do mergers and acquisitions. So it is the lifeblood of the business, and it is actual tangible cash and not an accounting metric like earnings per share. They've had a really nice step up also in free cash flow per share. They're expected to take a step back over the next 12 months, but you do want to see that trend going up and to the right for earnings per share and free cash flow per share, which it has. There's not a lot of cyclicality with the sales growth, which has been in the high teens, low 20s since 2021. They don't buy back that many shares. It is basically flat since 2015, but they're still increasing their sales. They're still increasing the cash flow. So the business does seem to be firing on all cylinders in those regards. And we definitely love to see those total sales going up and to the right. Margins look very solid for Badger Meter. Return on equity of 22%. Return on invested capital of 20%. Remember, return on invested capital is how is management doing with all the money available to them, whether it is through debt or shareholders' equity. So they are doing very well allocating that capital. Operating margin, or the EBIT, the earnings before interest and taxes, has been going up. Free cash flow margin, currently 18 cents out of every dollar coming in the door in sales is making its way to free cash flow. Remember, that is the lifeblood of the business. So the higher, the better of a free cash flow margin. So just very, very solid numbers. And according to SimplySafe, there is no net debt to capital. So it's saying that 100% of their capital structure is from shareholders' equity. And if you don't know what the interest coverage ratio is, it is how many dollars of operating income, also known as EBIT, earnings before interest and taxes, does a company have to cover every $1 of interest on the debt. So we'll see if a couple other companies actually have some net debt on their books to get an interest coverage ratio, but if you got zero, that looks fantastic. Stock number 2 is LeMaitre Vascular, ticker LMAT, and you can think of them as a roll-up shop, which means they buy small medical devices for vascular surgery that big companies like Medtronic ignore. Then they scale them through their sales force. Things like surgical patches, grafts, and tools for blocked arteries, which is interesting because the population is aging, plus rising diabetes equals more peripheral vascular disease. They've got a 14% return on invested capital and more cash than debt. But their stock is down almost 8% recently because the medical device sector has been under pressure, but the long-term demographic tailwind isn't going anywhere. Think the silver tsunami is coming, and AI cannot replace a surgical device. LeMaitre Vascular, dividend safety score of 70 safe. Here's another one that some people say this yield is too small. I can't hang with the small yields, 0.92%, but boom, check that dividend growth out. 25% dividend raise in March of 25. And again, they have that market cap just a shade under $2 billion. So they are a small cap company with tons of room to grow. And if you're new around here and you see this beta and you think, hey Russ, what in the hell does beta mean? If you see a beta of 0.77, it means that it's low. So when the stock market goes up $1, LeMaitre should go up about 77 cents. But on the flip side, a little bit of a ballast in stormy oceans, stormy weather. When the market drops $1, LeMaitre should only drop about 77 cents. SimplySafe actually upgraded their dividend safety score in January of 2022 from 50, borderline safe. LeMaitre is currently riding a 13-year dividend growth streak. They grow that dividend very fast. A 16% 10-year CAGR, almost 14% 5-year, and again in March of 25 they shot that dividend up 25%. LeMaitre is currently hitting you with 80 cents per share per year, and using the 5-year average price to earnings ratio, they look like they are a shade undervalued. Now this is close. Their dividend is about in line with their 5-year average, but the price to earnings on a forward-looking basis, there you go, it is below that 5-year average. And they must have a lot of growth left ahead of them that the market sees because their PE is double that of the healthcare sector. So the market is expecting a lot more growth. Their free cash flow payout ratio, SimplySafe likes to see below 60%, which it is, leaves a lot of room to grow that dividend, and it has been coming down, which we like to see. And it's been coming down because there it is, the free cash flow per share has been going up. So it kind of moves inverse like that. Free cash flow per share drops, free cash flow payout ratio is going to go up. So very good trend from LeMaitre. Outstanding sales growth, little bit of cyclicality in there. Sometimes you get the mid-single digits, but a lot of times it's mid-teens to almost 20%. Now, yes, their shares outstanding has been going up, but sometimes companies that are growing a lot and acquiring to grow the business, it's not that big of a knock on the company when their sales are increasing like wildfire, like every single year LeMaitre's has been. Margins could be a little bit higher, but they're right in line with where SimplySafe thinks they should be about. Fantastic operating margin, very healthy free cash flow margin. Remember, $23 of every $100 coming in the door of sales is making its way to free cash flow. And for the second company in a row, it looks like they have no net debt. They have more cash and short-term equivalents than they do debt or long-term debt. And we do see that they have some debt on the books they're paying interest on because there is an ICR of 19.6. So what that means is that LeMaitre has $19.60 of EBIT or operating income to cover easily every $1 of interest on the debt. And number 3 is a company that I see all the time in my line of work, Cintas, ticker CTAS. And Cintas rents and cleans uniforms. In my line of work, there are production facilities where you have to wear a smock to be on the production floor. Who takes care of cleaning those smocks every single day that are going on into the production floor, off into the Cintas baskets and into the Cintas trucks to clean at the Cintas facilities? Yep, you guessed it, it's Cintas. They also handle entrance mats, mops, first aid kits, and fire extinguishers for businesses. It's also a subscription model where there's one truck, one route, which is recurring revenue every week, and customers don't cancel because switching is a pretty big hassle. The founding family, I found, still owns 14%, and the CEO is the founder's son. Their scale and customer retention make the moat stronger every year, but their stock is down 7% after mixed guidance for 2026, and some analysts think a decade of outperformance sets a really high bar, but this business is so easy to understand and so high quality that even at a fair valuation, you're getting one hell of a compounding machine. Cintas has a dividend safety score of 97, very safe. The dividend yield is less than 1%, so yes, some of you that are those high yield seekers, this won't be for you. But again, dividend growth of 15%, very fast they grow that dividend. And it does look reasonably valued, and it is the biggest market cap company on this list at $76 billion. Now, Cintas does have a 43-year dividend growth streak, and the note shows in 2021, Cintas switched from an annual to a quarterly dividend. So that is why it looks like it went down. But they increased the dividend rate from $2.81 to $3 per share per year. So they continued that dividend streak going. But look at this, a 22% 10-year CAGR, 20% 5-year CAGR, and oh no, they're slowing the dividend growth down, 15% growth in July of 2025. Cintas hitting you with $1.80 of annual dividends per share. They just crossed into that reasonable valuation range of expected $166 to $203. The dividend yield is about in line with the 5-year average. PE ratio on a forward basis is also about in line. And in line for such a quality company sometimes is about all you can hope for. But they are at the low end of their 52-week range. Cintas has that low free cash flow payout ratio just like the other two. Earnings per share, free cash flow per share generally up and to the right. Hit a little bit of a plateau there from 22 to 23, but they recovered nicely. Sales growth almost always positive except for 2020 2021 coming out of that COVID year, but then they're right back up into the high-ish single digits, slowly buying back shares down to 410 million outstanding. Sales up and to the right generally. Fantastic return on invested capital and return on equity. Both of those margins are growing and expanding, which you want to see the margin expansions. Same for their EBIT, their operating margin, and the free cash flow margin come down a little bit, but still a healthy 16%. So 16 cents of every dollar coming in the door of sales is making its way to the bottom line at free cash flow. Now they do have some debt, but it's manageable. 35% of their capital structure is debt, but according to SimplySafe, if they wanted to, less than a year to pay down that debt, 0.85 of a year is what that means and how you read that. They could knock out the debt with their EBITDA, which is earnings before interest, taxes, depreciation, and amortization, or bullshit earnings as Charlie Munger likes to call it. But check that out. Their interest coverage ratio is expanding, which is fantastic. 24.3. Remember, that means that Cintas has $24.30 of operating income to cover easily every $1 of interest on their debt currently. But I want to know from you watching the video, what stocks are you watching or buying that you think are cheap? Tell us in the comments below. I read every single comment. And please remember that a $500 stock isn't expensive if it's earning $600 per share. And that price alone tells you nothing about if a stock is expensive or cheap, and that the price to earnings ratio can give you a much better clue. And if you do want to see what this welder is buying and investing on, click the link below. Follow me on Blossom if you would like to, or sign up for the free and fantabulous weekly newsletter where I share all these stock portfolio moves and some stocks about to go ex-dividend and some interesting investing thoughts that I'm having with you every week for free. We started talking about Peter Lynch. We're ending with Peter Lynch, who's in this floating little box next to my head. He shared what he thinks is the biggest mistake that investors make, and I tell you all about it there in a fun and quick video. So if you click that floating little box, I'll tell you all about it there.